essentially, in a weird way, I kind of like to describe it as it kind of turns you into your own bank, because your bank account ends up being your house, and you're able to take the money of the house if you need and everything like that. And there's strategies there to really attack the interest and pay off the mortgage more quickly and go from that.
Hello, everyone, and welcome to Bamboo, Vancouver's property management and investment podcast. I'm here today with Jordan Kofsky of Jordan Kofsky Mortgages, and we're basically going to talk a little bit about the rates. That's, the normal stuff that's going on today, but more importantly, we're going to get into more of the tactics that you can use, either if you already have a mortgage or if you're setting up to get one, because right now it's not like it used to be when it was next to nothing for your interest. Yeah. So a lot of people are focusing on, just the lowest rate, and that's that kind of thing. And there's a lot more to this. So consider, I guess, mortgage 102, I guess, the second level. We're going to go a little bit deeper in this episode.
I appreciate that.
As opposed to just the usual stuff.
We did that 101 episode, I remember.
Yeah. You were definitely back on the show again.
Hello, everybody.
Welcome back.
Welcome. Thank you. Glad to be back.
Yeah. So I guess, we'll start off with the simple stuff. Right now, the current rates, what are they sitting around on average? I know there's a bunch of variables, but they're...
For sure. I would say there's a range of you're in the mid to high threes. Mm-hmm. Then you're getting to then you go all the way up to the mid to high fours, depending on the situation. Of course, that all comes down to amortization, term, all of the credit scores, all of that stuff sort of all kind of coincides into just figuring out what your rate is, which lender you choose, that sort of thing.
Okay, so it's a variable, but within that range.
Yeah,
for sure.
Yeah.
So now one of the questions that's been coming up a lot, because there's been so much talk about different rates and that, the ongoing battle of variable versus fixed.
Oh, yeah. The classic gauntlet.
Yes. What makes a better decision? And I guess because it's not a one-fits-all, what are some aspects that come in when making this decision, whether you want to be on a fixed rate, one term or one cost for 5 years, or the variable that can shift around depending on, it seems to be arbitrarily almost.
Yes. Well, right now.
Yeah.
I think where that really comes in is where do people feel comfortable? What is your personal risk tolerance? I think that's a really important sort of thing to think about. Mm-hmm. I have a client right now that, they're having a baby, in they're probably mere weeks away at this point, and they just did their renewal, so they're thinking we need to have some cost certainty right now.
Risk tolerance a little bit lower,
so that makes perfect sense of why they're going hey, I need a little bit of time to kind of figure that out. Totally fair. Mm-hmm. But at the same time, if somebody is more more open to looking at it and watching it and making sure they have a little bit more risk tolerance, because say they have a little bit more cash flow, they have more opportunities to take advantage of things, well then variable may make more sense in that situation. So it really just does depend. These days what I'm seeing is a lot of people are sort of going variable because they're seeing overall in the grand scheme of things is that there's more downward pressure on rates. All this said is that can change in an instant with what's going on in the world these days.
Yeah, seems to be like that.
Well, yeah, the Bank of Canada just paused again, kept everything steady, which is great in regards to that. But at the same time, they also made a point of saying there's upward pressure on rates because of what's going on in the Middle East. I don't know if you've heard. There's a bit of volatility in the Middle East these days. So there's that. Yeah. But then on the flip side of that, there is downward pressure on rates regarding what's going on with the U.S. and Canada and renegotiating CUSMA. Yeah. That makes a really big difference, because if that goes sideways, which with
it seems to be kind of in the balance,
right? With Donald Trump, you really don't know, and so it's a very interesting time with all this. If I would say though, if you are going variable, which is totally fair, make sure you have a good mortgage broker, something that you're willing to talk to often, because reaching out and making sure that you're on the same wavelength really makes a lot of sense. Because of course, what we learned was a couple of years ago is if the Bank of Canada says they're going to do one thing, they may not do that, because of course so many people the rates went skyrocketed.
Yeah.
When after telling everybody, no, we're not going to raise rates. Everything's going to stay steady. Don't worry. And a lot of people really got hurt in that.
Yeah.
And so it's really got to be focused on what is happening right now. Do you need to make changes? Talk about it constantly. I've really started bringing that into my practice myself, is calling my clients, making sure, hey, do you know what's going on? Do you have questions about all of this? And I have found that being a very valuable thing, because clients go, oh my God, I had no idea this just happened, or whichever. Yeah. So I found that being very helpful. So between the two, go fixed if you don't want to think about it. Go variable if you really want to have some management, but there's cost savings there when it comes to with the variable, or rather the potential for cost savings.
Yeah, so I guess it's almost a little bit of touching on like risk versus reward.
Yeah.
Right?
Yeah.
So when people are applying that, what is one thing that the people applying, the borrowers, think that really matters, but lenders don't really care about?
Oh, that's a great one. I love that. I've gotten a lot of things. So recently I've had somebody that was like, oh, hey, like he runs his own business. Mm-hmm. And then he's going, oh, well, I'm signing these potential clients. I'm like, well, have you signed them? Or are they clients yet?
Yeah.
Are they paying you? Where is all that? Mm-hmm. So the lender doesn't really care that you have hypothetically some money coming in.
Yeah,
that's not it. Right, that's not a thing.
Yeah.
So that doesn't really kind of line up there. Another thing is, a lot of people like to say, like, well, I have assets. I have like a house. Mm-hmm. Like I already have it. So therefore you just give me more money. I'm like, well, you don't make any money. So if you're making money and you have a house, that means you're sort of like in a cash poor situation. I'm sorry, cash poor, house rich, or excuse me, you know what I mean? House poor, cash, whatever. Yeah.
House poor, cash rich.
Thank you. That's the one. Mortgages are my thing. Not talking about idioms. Not talking about idioms. Thanks. So like that's something kind of that I focus on a little bit. There is a lot of people sort of get focused on that. Like they're like, oh well, I have a house that has like a mortgage on it and everything like that. So therefore, you'll give me more money. No,
that's not how that works.
Why would they give you more money? You're only affording what you can now. And if that's also a concern, because maybe you can't actually afford what you have. Mm-hmm. And that's also a thing.
Now, that actually is a good segue, considering that we've been told repeatedly that there's this mortgage cliff and all these renewals are coming up and all that.
Right.
Two parts. One is that cliff actually existing, because we've been hearing about it for over a year now, and I don't know if anyone has fallen off of it yet. As well as when they do have to renew, if you already have a mortgage, of course, what is some leverage that a homeowner would have to help against with a bank there, as opposed to just, here's your rate and beat it?
Yeah. Well, yeah, this is actually really common, is a lot of people really think that they're kind of locked in with their current lender. Mm-hmm. And so what happens is they get sent a letter. The letter says, hey, here's your different rates that you can get, 1 year, 2 year, 5 year, 3 year, whichever, variable, fixed. Mm-hmm. And so you a lot of people just kind of pick that one. Yeah. That is not generally the best strategy.
Okay.
A really good strategy there is, you see that, go, great, that's interesting. Mm-hmm. And then contact a mortgage broker, have a chat with them, and see what makes sense for you. It is the best strategy, the rate strategy to get the best, lowest rate. Or is it more of a cash flow strategy? Or is there a situation where you could need to do something like pull equity out and things like that? Or do you have refinancing to deal with, credit cards and other loans you need to pay out?
Yeah.
So that's kind of the time to do that. And then other lenders offer different, variations therein to offer those kinds of opportunities to give yourself a better opportunity there. So leverage-wise, it's always good to look around and see what works best for you, and talk to a mortgage broker that can kind of work with you to make sure that you get the best product that works best for you.
Mm. So yeah, basically shop them around would be one of the strong advice, right?
Yeah, shop it around. Take a look and see what's going on. And then, as you mentioned about like some ongoing cliff, I think what you mean by that is like, is there a huge risk of defaults and things like that?
Yeah.
Because there's going to be the sticker shock of people getting, those amazing COVID rates at 1.7%.
Yeah.
That's incredible. You know what I mean? Like, there's that sticker shock, and now you're in the mid fours potentially.
Yeah.
What are we doing there? So what happened is like, that's largely not seen as something that's happened, is that there hasn't been a huge default all across Canada. Like, we just don't see it. Like, we just, like, you know what I mean? Like, are prices coming down? Well, overall, we have seen that. There has been some. Yeah. But it's not like this massive exodus of people being like, oh my God, I can't afford anything. It's just not happening.
Yeah, I think that a lot of it was pushed because of what happened in the States during the mortgage crisis, where it was like very predatory.
Yes.
As the lending. You're like, oh, you're working as a car lot wash guy. And it's like, yeah, you can have that 5-bedroom mansion. Go ahead.
Yeah, exactly.
Like, that's not how this works. And I think that a lot of the people have listened, because we get inundated with the States news and TV and whatnot. So our system is significantly different, right?
Absolutely.
So I think that probably has to be a little bit of that. And besides, let's face it, fear sells headlines, right?
Well, yeah, absolutely. And like, there's lenders that I deal with and we talk to about all the time. And people really think that, like, it's like, well, what's in it for the bank? Well, the bank can repossess my house. I'm like, the bank does not want to repossess your house. Nobody wants to do that. That's not a thing. Like, nobody wants to go through that battle. That's awful. So, like, they just won't lend you the money. Like, they just won't do it. So in the same situation, like down the road, if you're not able to pay and things like that, banks are generally going to try to find a way to make it work as best as possible. And again, we're just not seeing mass defaults. We're just not seeing that.
Yeah, which is a good thing. I mean, we talked about it on a previous show at the start of the year with another realtor, how we were all, when the stress test came in and we're like, what a waste of time. Why are we doing this? And I was like, oh, that's why we're doing this.
Yeah.
Okay. Never mind. It makes sense now.
Yeah. I mean, well, that's a great point, because the stress test was like let's say around 5%. Well, that's where rates sort of like went to. I mean, yes, there were higher ones and things like that, but in general, that's kind of where rates went. So if you're able to stress test at 5% or so, then it's a really good situation for you. That was where the stress test was. Now, of course, the stress test is a bit higher because rates are higher.
Yeah.
But overall, again, it's good practice just to make sure, like, hey, we want to make sure that you're not in, again, house rich, cash poor.
Yeah, absolutely.
I said it right that time.
Yeah. Bang, nailed it.
Right. I'm proud of myself there. All right, this interview's over.
So going through that, like, we've now talked about some of the ins and outs of the actual mortgages and that, but now trying to share a little bit more of the tactics, because there's a lot of things people can do and set up ahead of time in a lot of cases, but also, when they're in their renewal and that, as it's a whole other show. But can you briefly give a high overview of what the Smith maneuver is? Because that's been something that's getting shared a lot on social media. And of course, somebody tries to explain it on TikTok and they skip over a couple major parts of it. And so people can hurt themselves real bad if they don't do this right.
For sure. So here's my disclaimer about that is, let's start off before I jump into a little bit about the Smith maneuver is say, hey, if you're looking at doing the Smith maneuver, talk to a professional about this first. Sit down. Right? Talk to a broker, talk to tax people that really understand that, talk to your financial planner, get your team involved that can kind of work all this out.
Yeah. Talk
to your realtor, make sure you're all working together to make sure this all lines up the right way. Because if you line up something incorrectly, then it doesn't work, and then you're real in trouble.
Yeah.
So it just makes sense just to pause for a second, take a look. Is it something that could be valuable? For sure. It's a really great maneuver to save some money on tax.
Yeah.
And then thus use that opportunity to pay off your mortgage. But I just want to say a caveat is, make sure you talk to people before you start, kind of implementing this kind of strategy. So
yeah, it's definitely not one that you're going to learn off of YouTube.
No,
don't do that.
No, that said, you're going to learn it in about a 30-second podcast right now. But more importantly, really, just a high level view of that is essentially what you're doing is you're converting sort of like non-tax deductible mortgage debt, and you want to convert that into investment, tax deductible investment income.
Yes.
Debt. You know what I mean? That sort of situation over time. So essentially what you're doing is you take you have a HELOC on your property, and then you use that money, hypothetically, you use that money from the HELOC in a revolving, mortgage HELOC scenario. You use that money, and then you put it into something that it theoretically brings in income. So say a rental property, say investments or whichever, those and all of that, then the interest earned there becomes tax deductible there. And then so if you use that, and then you use that sort of the tax deductible savings there, what ends up happening is you end up getting a refund often at the end of the year. And if you can use that refund, you can use that money to pay off your principal.
Yeah, raise a bump payment,
right? And then and then as that goes along, you sort of turn this into a recycle, and then you sort of keep paying it everything down, and you have more and more available to you that you can then leverage, which of course is what, more wealthy landowners are able to do. They leverage some of their debt to make more savvy investment properties.
Yeah, absolutely. It's one of those things that everyone says that, buying a home is an investment. It absolutely is. However, an investment is supposed to help make you funds.
Yes.
So therefore, if you're not using any of your home equity, you essentially just have a debt.
Yes,
right?
Correct.
In a very high level way. I mean, there are, of course, other things added to, if you own your own home, then you don't have to worry about someone knocking on your door, like a landlord-tenant situation where, I'm going to sell it, you need to move. Damn it.
Well, yeah. I mean, like that's always, I think, what realtors and mortgage brokers, we say, like, you don't want to be paying someone else's debt. You know what I mean? Like, at least you have the opportunity to pay off your own debt, which is key. But if you're able to leverage some of that and put yourself into a more advantageous position, down the line, I think that's something you should at least explore.
Absolutely. Now, with debt, because we're saying that you have that, what are some of the stronger things that you can just do ASAP, like bubble payments, changing your frequency, etc.? What are some of the best moves to do just as a simple one?
Absolutely. I'm a huge believer in this process. There's different sort of lenders offer different versions of this sort of process. And this, again, is where a mortgage broker really comes in handy, because the rate that you get, it's just a number. And I always kind of say it this way, is the rate that you get from the bank or whoever is the minimum amount that you have to pay, but it's the maximum amount that the bank can make off of you.
Yeah.
Right? So if you are able to use those lump sum payments, or you say bubble payments, or change your frequency and things like that, and you're able to pay off your mortgage principal more quickly, the net effective rate is far lower or different than the piece of paper that they gave it to you on.
Yeah.
So you're actually much more, it becomes much more advantageous and much more, you can pay it off more quickly. So one thing I really like, and again, different lenders offer differently, is those lump sum payments.
Yeah.
Some let you do like 15%, some let you do 20%, some let you do even 25%. But then where that sort of changes a little bit is some let you do multiple payments throughout the year. So let's say one lender will say, okay, I can give you 20% one time per year, and it's on the anniversary date.
Yeah. Right?
Well, okay, great. When you realize what that means is that the lender is actually going to be making interest off of you for the entire year, right? That's not as good as, say, 15%, say, hypothetically, and you're able to do multiple payments throughout the year. So you make a little bit extra, like a Christmas bonus, or one of your investments did well, or, some inheritance, or you just seem to have a little extra money that you just want to throw down on your mortgage. Just do it, and it goes directly to principal. Right? That allows you, again, to pay off the mortgage more quickly. And then the net effective rate, obviously, would change. It becomes lower and lower because of that. So I think that's where that one really becomes really important there. The other one would be, of course, payment frequencies. If you change your payment frequency from monthly to, say, bi-weekly, or frankly, I had a client that was amazing. He went weekly payments, and I was blown away by it, because I was chatting with him, and it was time for his renewal this year. And I called him up, and I was like, okay, let's talk about where your situation is. We were talking throughout, but then he sort of was I was very wide-eyed about it, because he went in and explained. So, like, last couple months, we went really aggressive. We changed to weekly payments. We changed it to, doing lump sum payments, everything like that. They moved their mortgage from, like, say, like overall over the course of that 5-year period, incredible, from about $600,000 or so to $200,000.
Wow.
I was like,
that's a heavy hit.
Wow. Wow. It was absolutely incredible. And they were like, frankly, like, moving the mortgage. Why at this point, right? We were talking about renewals and things like that. If we're able to pay it off more quickly anyway, why would I want to worry about?
Yeah. Like, why rock the boat if you're just going to have it dealt with?
I'll pay it off in 3 years, in a couple of years anyway.
Yeah.
So a rate in between, say, at the time, say 4.4% versus 4.2%, who cares?
Yeah, it's not going to be there that long.
No, it's just like we'll get this done anyway.
Yeah,
which I totally appreciate and I totally respected that. So that's sort of where that can kind of come in. So look at those options in doing that. As I said, the biweekly payments, just kind of get into it a little bit. Yeah. Is that situation where with that is that it goes like, if you change your payments to bi-weekly, it basically makes your payments go from 12 to 26. And if you divide 26 by 2, that's 13. That means you're actually making one full monthly payment extra without you really even noticing.
Yeah.
Which is extremely effective in paying that off.
So yeah, if you're making one extra 1 month payment per year, give or take, most mortgages are 25 years. How many years do you figure that will cut off?
Yeah,
give or take.
Yeah, it's usually in around like 2 to 3 years.
2 to 3 years.
Yeah.
So you drop from 25 to 22.
Yeah,
which is a substantial savings on interest, of course, right?
Well, let's hypothetically say, like, in this context, it's about like 50 grand. What would you do with 50 grand? Maybe you can invest that property. Maybe you can invest that and save some money on something else, or use it for a really awesome vacation or college funds or any one of those things.
Yeah. So even making just one bulk payment sometime throughout the year of 1 month of your mortgage is actually pretty substantial over the course of your 5 years, I guess.
For sure. And I think what people should do is use both. Do the lump sum payments, put it into bi-weekly payments and things like that. I mean, goodness, when everyone sort of got caught in the variable rate situation and everything kind of went bananas. Like in my situation is like, I was thankful that I had bi-weekly payments. And then I also was able to use the lump sum payment situation and multiple times. So I was like, okay, I've got a little extra money because I've saved, because the rate was so low in comparison for a while. I took some of that money and just threw it right on the mortgage right away. And that kept the amortization at bay. And it's because you heard people getting these situations where their amortization was like, 57 years.
Yeah.
Right? You're like, whoa. So in that situation, when you're able to look at that and then sort of manage the situation by putting a little bit more money onto it, in the end, I think the worst it got was that it went to 32 years, which altogether wasn't that bad. Yeah. And then by the end of it all, I think we got it right in line.
Yeah. So it certainly seemed to have dropped back because we received that, and then the bills, the rates changed again, and now we're back down to like normal. Because I was one of those people on the variable from TD who sort of just sprung that out, like, oh wow, it's 57 now. That's a lot of years now.
Yeah.
But now it's returned back.
Correct. TD is a great example for that. I love that you brought that up, because TD's variable rate is different than some other lenders' variable rates. So just keep an eye out. There's different versions of the variable rate as well.
Which I learned.
Right? So a lot of people think with the variable rate is your payment will change and fluctuate immediately with the Bank of Canada. No, not necessarily. Yeah. Some do that, and some go, your payment stays fixed, but your interest versus principal will change.
Exactly.
So that's how you got into that whole 57 years or 62 years or whatever. And so if you're able to see that and go, oh, okay, what can I do here? Change your frequency, we do the lump sum payments, that kind of thing. Yeah. And then that allows you to pay it off more quickly and gets your amortization back in line. And no one likes to pay higher rates, of course not. But if you can sort of manage the situation, that's the best you can do in that situation.
Which is also kind of an interesting thing with TD, because, like, granted, we were kind of pissed off about it since we had thought that we were on that variable where it just goes up and down, because that would have been more palatable. So they have since moved our payments up. And then now the rates have dropped back down again. We asked them, so can we put it back to where it was? They said no.
Right.
But we're actually not too upset about that, simply for the fact that now I have a built-in lump sum payment. Basically, I'm paying a little extra every month. It hasn't been that bad, and now we're actually doing better because is forced us to pay that little extra. So it's not as bad as it was. Did kind of piss us off at the start, not going to lie.
Well, yeah, because basically, let's say the variable rate is 3.5 and you're paying 4.5.
Yeah.
Well, now that extra full percentage point that you're putting down towards is going on your mortgage directly right away.
Exactly. Right into the principal.
Right. And so it does sort of work in that regard. Yeah, I mean, and then, as you mentioned, it can be more palatable. It really depends. I mean, I guarantee you that client, let's say, that one that I mentioned way back at the beginning of this, so it's they're having a baby. And let's say they did decide to do the variable, hypothetically. Yeah. We talked about it. I would imagine they would feel far more comfortable in a payment fixed variable rate than one that fluctuates the whole time. So again, it just depends on who you are.
Yeah.
So I kind of want to highlight that just because it's like, it really depends
on what you're doing.
What's going
basically,
on?
Right?
Yeah.
Which actually, if you were given extra money, what do you think is your best move to do? Do you pay down the mortgage, invest in something else, build cash reserves, put it towards another property? Like, what do you think in current market? What would you say is a wiser move to do?
Well, I want to keep this somewhat evergreen. So I think the best thing to do there is, and excuse me for a bit of a cop-out here, but it is talk to your realtor, talk to your mortgage broker, talk to your financial advisor, and get it all organized so you have kind of a strategy in mind. Do not just throw money onto your mortgage. That's not always the best solution.
Yeah.
Because what if, let's say you're talking to somebody that, like someone that understands finance and knows your finances really well, or you have an opportunity to invest in some new company or some opportunity there, hypothetically, and that has a higher return. Well, then maybe that would be a better choice than just putting it onto your mortgage. Like if you're just putting your money onto the mortgage, but then you miss out on an opportunity that gives you a higher return. Well, then why would you do that? That's a bit of a miss. So you want to look at your net gains, so to speak.
I got you.
You know what I mean?
So that kind of makes more sense to try to put a HELOC, which stands for a home equity line of credit.
Yeah.
For those who are just catching up on here. So does that make sense to obviously get a HELOC? And we were talking before we came on air about this Manulife One product.
Yeah.
So maybe tell people about that, because I mean, even as moms was saying, it sounds too good to be true. So there's obviously some issues with it, but touch on this because it's a pretty interesting product, actually.
Thanks. I appreciate that. Good old sales pitches. I appreciate it. Is like, so regarding HELOCs and things like that, I do think the HELOC, like getting a HELOC or having access to a HELOC is in general a very good practice. Mm-hmm. Of course, everybody needs to have discipline in their own income and their own money. Like it's like, you don't just have free money. That's not how this works. But you do have access to the money if you need it for like a rainy day fund, or you need it for a vacation that you really want to do, or whatever. It's good to have that money available to you if you need it.
Yeah, absolutely.
That said, with regarding the Manulife One, and I really appreciate you bringing it up because I was just sort of blown away by this product. Is what happened is it's very popular like outside of North America. Mm-hmm. And what happened was, my understanding a little bit with how they got into this was back in the 90s, there was banks and insurance used to be very separate, but then all of a sudden banks started doing insurance. You can see TD Bank do insurance now. What happened was, so banks were able to kind of dabble in that way, but Manulife is very known for its insurance, but they went the other way.
So started dabbling in mortgages. Okay, I get you.
So that's sort of what happened there. So their product is fundamentally different than regular traditional banks. So the Manulife One product essentially, in a sense, like, again, talk to a mortgage broker to kind of go over it, but I'm just sort of kind of laying it out very, very simply. It sort of converts your mortgage into a HELOC. Like if it's 65% loan to value, you can just go right from the mortgage to HELOC. Mm-hmm. And then as a result, HELOCs have different ways of calculating interest. So with traditional mortgages and everything like that, it's the interest is brought up through is based in arrears. However, it's compounded based in arrears. However, with Manulife One, it's sort of done with simple daily interest, which is significantly different. So even if the Manulife One product, which it is right now, the rate may be higher, you're actually able to pay off your mortgage far more quickly based on how they structure and then they calculate the interest. Mm-hmm. So what's happened is, like, I was kind of walking through this with a client, and we were sort of blown away. Is I literally was on the phone with them, and we're in a meeting. We jumped on the calculator on the, went through it, and I showed if you did everything how the Manulife One is structured, you're able to pay off. Their mortgage was currently at 25 years to start. So they've been in the mortgage for 3 years. So now they're at 22, right? So then naturally, if they just continue on, it'll be paying off their mortgage in 22 years.
Yeah.
Manulife One, they move it over. They're able to do it in 3 years and 2 months, and they save $157,000 in interest. And we both went,
huge job.
Whoa, like that's amazing. And they also have access to more money in their home because they had more. They had lower loan to value than 65. So they're able to, if they want to take out extra money, they can and everything like that. And if many people don't feel super comfortable with like that huge of a HELOC, which I totally understand, you can set it up and be like, okay, I want less of it as a HELOC and more of it as a fixed rate mortgage or a variable rate mortgage. You can set up that way too. And you can have different sub accounts, different things like that. So if you're into investment properties, you can have it all organized so your tax people can have it very clearly laid out.
Yeah, that's what it is.
Right. So that's really effective as well. It's a really sort of standalone, very different product, but for the right person, it's the right product. That said, for the wrong person, you're going to want to keep an eye on this because everything sort of turns into one bank account. So your paychecks, everything like that, if you want to set it up and be as aggressive as you can, you put your paychecks into the Manulife One and it pays off the mortgage more quickly right away because it goes right directly to principal after the interest only is paid out. What happens is if you start taking money out of that account, which you can, right? Then you want to get that Ferrari, or you want to take a trip around the world, and that costs a lot of money, and you're taking that money out of that account. Well, now that interest only payment and the money that you owe is now grown. Mm-hmm. Well, now you got to be careful. So you got to make sure that you're keeping an eye on that. You make sure it's all organized the right way. So if you're financially disciplined and you want to follow along and do it and be savvy with your money, it's a very good product to have. If you just aren't very good with your money, full disclosure,
stay away from it.
don't do it, or get somebody to manage your money for you, and then you can sort of sort it out that way. But essentially, in a weird way, I kind of like to describe it as it kind of turns you into your own bank, because your bank account ends up being your house, and you're able to take the money of the house if you need and everything like that. And there's strategies there to really attack the interest and pay off the mortgage more quickly and go from that. So, of course, going to shamelessly plug it. If you want to call me or reach out to me, I'm more than happy to help, or reach out to Hayes. He'll connect you with me.
Yeah, for sure. With that, though, I mean, dropping from 22 down to 3, I mean, there must have been more to that. That's a very aggressive drop. I mean, were they just putting every cent that they had into this, or because that's a huge,
for sure. So what happened was, they were somebody they wanted to make sure that they didn't they didn't want to be house rich, cash poor, as we put it. Mm-hmm. So as a result, they had more savings available to them. Yeah. So it turns out they make something like, between the two of them, they were making, I think it was $9,000 a month, roughly, net. And then at the end of the day, they also had these expenses. The expenses were, say, $3,000 a month. Mm-hmm. Well, now you have $6,000 to play with. What are you going to do with it? So instead of letting it sit in your savings account, you put it into the Manulife One right away.
Okay.
Right? So then every single dollar after, say, the interest only payment was about $850, $880. So after that, every dollar goes directly to principal.
I gotcha.
So what I was saying to them was that when you have the opportunity to go get groceries and things like that, use your credit card. Do that. Then at the end of the month, when you have to pay your credit card, pay your credit card, and then the next day when you get your paycheck again, goes right back onto the mortgage. And then again, so then the interest accrued on one day up, but then for 30 days after that, or whichever, it's paying down the mortgage more quickly. So again, that it becomes more effective in that way. But again, if the client say wanted to go get that Ferrari, well, may not be the right product for you.
Yeah.
You need to really be disciplined.
Yeah, make sure that you don't just go buck wild, basically.
Absolutely. Absolutely. And again, that's where it becomes really important. But when we're talking about Smith maneuvers and stuff like that, that product really works for that because it's all clearly laid out. And it's all revolving mortgage, revolving HELOC, which is what you need to set up for that Smith maneuver.
So yeah, there's a giant conjunction. You can really get rid of your mortgage and stop paying the bank, because let's face it, the bank doesn't want you to pay off their mortgage.
Correct. That's exactly actually the point, which I think is so interesting, is that the rate, as I said, the rate is there, but the rate is the minimum amount that you have to pay, but the max amount that banks can make off of you.
Yeah, exactly. The one thing that I also, because I did touch in on TikTok, because that seems to be the bane of people. The people are learning things they should not be on TikTok. You can't explain something in 30 seconds that's way bigger than that.
Right.
Smith maneuver being a prime example.
Mm-hmm.
What is some of the dumbest financial advice that you have seen online? Because we all get that feed and you're just like, what?
Yes. Yeah. The easiest ones that I see a lot is stay away from, the easiest way I can describe this is stay away from the absolutes. when they say you absolutely need to put 20% down. Well, not necessarily. I mean, there's all sorts of reasons why you may not want to do that. So there's that. Or I've seen the one that's like, you absolutely need to pay off your mortgage right away. Believe me, as a mortgage broker, I actually want you to do that. I don't believe in paying the bank any extra money than you have to.
Yeah.
But as we alluded to earlier, if there's an opportunity there to actually invest that money into something that will give you higher returns, well, then do that. That makes more sense logically. So there's things like that. So really sort of staying away from the absolutes is really key. There's never one size fits all. It's not like you have to do it this way, you have to do it that way.
Yeah.
In general, though, I do believe in paying off your mortgage, as I said, but maybe there's other things around that. So the dumbest ones are always those ones that are like, this is the only way to do it. And if you don't do it, you're stupid. You're like, no, stop it.
Usually the crypto bros.
Yeah, right. Yeah, exactly. The crypto bros.
Wicked. Well, I think we got through a fair amount of our information here because we don't want to overload everybody. And then let's talk to the next show.
Yeah, I appreciate that.
But is there anything else that you like? You're yearning to get out there in the mortgage investment world that we haven't covered?
Well, I'd love to actually get into a bit more about reverse mortgages. So I'm just going to really quickly lay it out here really fast. But then maybe we can talk about it another time.
Yeah.
But I really think that reverse mortgages are something that gets a bad rap. A lot of people here in Canada remember the reverse mortgages in the U.S., where Tom Selleck, sorry, Magnum PI, you had all those great ads. But then what happened was people that did reverse mortgage in the States, they actually did go after your homes. They took them. And that was a really big issue, of course. So people think here that can happen.
Yeah.
We have laws against that sort of thing.
Okay.
So the Home Equity Bank won't do that. That doesn't exist. Yeah. They do the CHIP, what's called the CHIP reverse mortgage. Other lenders that offer the reverse, they can't do that. They can't take your money. They can't take your house. It's not. If you're able to afford it, there's nothing there. Yeah. I think people get really concerned about that. That said, it is an extremely helpful product that people that are cash that again. House rich, cash poor. Like they have money in their home, they have great equity and things like that, but they don't want to move out yet. They have access to that income, they have access to that money, and there's opportunities and ways to use that in very flexible payments and things like that to give them more opportunities down the line. And you can use that money towards financing your lifestyle. So you want to go on vacation if you're a little older and you're retired and things like that, or you really want to go to the movies and get some popcorn. You can do that, I suppose.
And they're almost the same price as the mortgage these days.
Oh my God. Don't we started Cineplex. But then, and then that said, but there's other solutions that people can look at. Like we were going to quickly say that, helping clients that like need money for a down payment. Well, parents want to give a little bit more of the, bank of mom and dad's there. Yeah. Okay, well, here's the inheritance early and I want to see you enjoy it. There's an opportunity there, opportunity for, older folks to use that money and say buy an investment property for themselves. And then they use the rental income that they earn to pay off the mortgage, pay off the mortgage. And then if you flip that around, and then when the time is right, and the parents and the people that own the home, they want to move. Okay, well then they sell their home. Then the rest of the mortgage is paid out. Yeah. And then they move into their already usually very appreciating asset here in, let's say they're living in Yaletown or whichever. Yeah. And that's a very effective strategy.
Oh, for sure. Well, yeah, we definitely will touch in on that in a couple of shows for sure.
I hope so. I love that, bro.
So if anyone else is trying to get a hold of you to talk about maybe reverse mortgages or any of the other products that we talked about, what's the best way to find you?
Oh, great. Google, just look me up, Jordan Kofsky, mortgage broker. You'll definitely see my Google reviews there. Last time I checked, they were all good, so cross my fingers. Or reach out to Hayes. Hayes will hopefully connect you with me. Or just give me a call. Look me up, as I mentioned, look me up on my website, kofskymortgage.ca. You'll be able to find some more information that way and be able to connect with me anytime. And I'm more than happy to help.
Yeah, and we'll also have all your information in the description below and the bottom of this episode because people may not know how to spell Kofsky. So
yeah,
good.
Yeah.
And thank you very much. If you guys have been listening for this long, we really appreciate you joining us. My name is Hayes. This has been Bamboo, Vancouver's property management and investment podcast.